How do central banks control inflation? This episode is all about how and why they do it, and what it means for your investments. Inflation is a really important topic, not just for you and I who have to account for the rising cost of our weekly shop or fuel at the petrol pump, but it's one of the biggest concerns for central banks too. It's their mandate to keep prices stable, prevent economic ups and downs, and maintain the value of money, essentially sanding down the bumps in the road to make the economy run more smoothly. When inflation is under control, people feel more confident about spending and saving, and that helps the economy grow. In short, this is mostly done through interest rates, and there are three key nuances. Firstly, central banks can literally just increase or decrease short-term interest rate. When they increase rates, they're hoping to slow the economy down. Slowing the economy impacts things like wage growth, and if you borrow money, it costs more to do so, so things get more expensive. On the other hand, when central banks lower rates, they're stimulating the economy. When rates are lowered, I'm not going to keep my cash sitting in a bank account as it earns increasingly less. I'll be rather inclined to spend it, flooding the market with money. Central banks can also impact interest rates by steering the money supply. By buying securities, central banks are flooding the banking system with money, which can help lower interest rates. On the other side, selling securities means they're taking money out of the banking system, which can raise interest rates. Central banks can also set the requirements for how much banks must hold as reserves. Lowering reserve requirements increases the amount of money banks have available for lending, which can lead to lower interest rates as banks compete to lend out their excess reserves. If reserve requirements are higher, banks have less to lend, and interest rates rise as competition for those loans increases. Central banks can also target specific asset classes, things like real estate, when prices are overinflated. Although central banks cannot prevent these inflation bubbles from forming entirely, using their abilities to manipulate interest rates can stop certain parts of the economy from overheating. They also use tools like regulation and stress testing to monitor the situations. When we talk about interest rate changes, we're conditioned to care not just about our own central bank decisions, but those of the US Federal Reserve. So why all the fuss about the Fed? It's not just because the United States' significance in global trade and investment flows. Indeed, the US dollar still enjoys its unique status as the world's main reserve currency, and there are no signs of this changing anytime soon. The vast majority of global trade in goods and services is still conducted in US dollars, and the greenback also retains its clear dominance in global foreign exchange markets. The US dollar also dominates the reserve holdings of most central banks. As a result, the Fed's decisions reverberate throughout the global economy, and its policies constitute one of the most important variables that you, as an investor, must take into account. If you have investment questions you'd like us to answer, just comment below. And don't forget to like and subscribe. We'll see you again soon.